About to crash everything, silver stackers are not ready for October 14th. Something big is brewing for silver stackers, and hardly anyone is talking about it. October 14th, circle that date. Check this out. If you're interested in silver, click that link in the description. Money Metals is holding this contest. They're giving away 20 American Silver Eagles. Every month they hold this contest. Last month's winner was Brett from California. You should be the next guy taking home that silver. Click that link in the description down below. Be the next winner. Take home that silver. Now, look at this. October 17th, that morning, the U.S. Bureau of Labor Statistics will release its Producer Price Index, the PPI. It's one of the most overlooked but powerful inflation reports on the calendar. PPI doesn't grab headlines like CPI does, but it's where inflation actually starts. PPI tracks the prices businesses pay for goods, the prices they pay for raw materials, and the costs before they even reach the consumer. So when those input prices surge, producers eventually pass them on to shoppers. When they collapse, it signals deflation pressures are building. And for silver, which sits right at the intersection of industrial metal and inflation hedge, PPI data can cause immediate whiplash for our spot price. Think of it this way. CPI tells what's already happened to prices in the checkout line, but PPI tells you what's coming next. And that's what we need to know as silver stackers staring at this spot price. In the early 80s, when inflation data kept surprising higher, silver's volatility went insane. There were days where it swung 10% or more, and traders reacted to each government print. That's what was happening. The same dynamic still exists today. When producer prices surge, silver can spike as investors hedge against future inflation. But when they fall sharply, industrial demand fears take over and silver gets slammed. Here's how it's going to happen. If the PPI comes in hotter than expected, it signals that inflation is reaccelerating at the producer level. The Federal Reserve, already nervous about price stability, the Federal Reserve might talk tougher, perhaps delay rate cuts or even hint at tightening again. That pushes real yields higher and the dollar stronger. Silver, in the short term at least, it could take a gut punch. But the story doesn't end there, because hot producer prices often rattle equity markets. Stocks can tumble, risk appetite could fade. Suddenly investors rush back to silver. They rush back to that safe haven, those hard assets. Silver has the potential to reverse on a dime. It could climb sharply as traders adjust. That's what can happen. And if you flip the scenario, PPI shows deflation, falling input prices, lower factory costs. That kind of data screams recession ahead. That's what it tells us. Commodity traders often dump positions to wholesale, and silver can slide along with base metals. That's why PPI is so dangerous. It probes both sides of silver's nature, inflation hedge and industrial commodity. October 17th may look like an ordinary Friday, but beneath the hood, when we see what's really going on, it's a seismic risk building. PPI index is really key for the price of silver, so check it out closely and get your own silver. Click that link in the description. Thank you, Money Metals Exchange, for sponsoring this channel. It's a great contest. Every month they're giving away 20 silver eagles, 20 eagles every month. Click that link, take home that silver, and I'll see you on the next one.